Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski, and my co-host is Paul Municle, as usual. Welcome back, Paul.
Thanks, Ron.
And Paul's with Ameriprise. He's going to give us an update as to what took place in the marketplace. And Paul, I've got the last-minute information that Ameriprise sent me, and we'll share that with the viewers, so I'll let you take it away.
All right, I'm going to do today's show by recapping the market activity through last month, just to kind of give you an idea where we officially stand. So looking at the monthly market recap, we're down for the month, but we were up for the quarter. So the S&P 500, it did fall by 4.7% in September. Now that was busting its 7-month winning streak. The decline, however, was not enough to send the index into negative territory for the quarter, thus bringing its quarterly winning streak to 6 and a 14.7% gain year to date. Now that's price only. And all that data is according to FactSet. Now dating back to 1929, the S&P has only mounted 11 other winning streaks this long. Unfortunately, the broad U.S. equity market, represented by the Russell 3000, couldn't match the S&P 500's quarterly gain, as it did decline negative 0.1% on the quarter, just barely negative. Switching over to fixed income, those markets were mostly able to generate a fractional positive total return for the quarter. The key word there is fractional. The Bloomberg U.S. Universal Bond Index returned positive 0.1% for the quarter. Now looking ahead, we do expect economic trends to remain largely positive. Short-term events and activity, however, remain very dependent on the course of the COVID virus around the world. Global supply chain problems were made worse at times in Q3 by renewed virus outbreaks in many areas of the world, and COVID-related fears led some consumers to pull back their spending on certain services during the period as well. Though slower, economic activity and corporate profit growth should have remained solidly positive in Q3. We do believe trends on both fronts may be improving as we head into Q4. However, the current strong inflation impulse may limit investors' appetite for risk. So it's something we got to watch. We've been talking about inflation on other shows, Ron.
Yep.
Still a concern. Still something we need to be aware of, and that will have or should have its impact on the market.
Yes, direct impact, actually. And this morning's news that we got from Ameriprise, the S&P index futures are slightly higher as the index looks to avoid a third straight day of losses. And you addressed some of that. So the market's probably going to be jerking up and down.
We'll see. I think jerking up and down is correct. Potentially more downside coming. It just feels like we're in a downward trend. That's just my feeling, but we'll see. You know, yeah. Any bit of news is going to affect the market.
And you've been through a lot of these in your life.
Longer than you think, yeah. Over 20 years.
Yeah, the yield on the 10-year Treasury fell back below 1.6% ahead of the new job openings. And there's going to be a meeting this morning. I guess we'll find out more about that.
Definitely. Wait and see.
Yeah. For those that are investing, the stocks in Europe are off the lows of the session, but remain in the red as energy prices weigh on sentiment. So
we have those same problems here. You commented even last week on how the price of oil is going up. Energy is getting higher, and that does have its impact on the markets.
And for those that are investing, again, shares of the GlaxoSmithKline are higher after Bloomberg reported that the company's consumer products unit is attracting buyout interest from private equity firms. So it looks like they want to move on.
We'll see.
Yeah. Year-to-date index returns are pretty solid, Paul. The S&P 500 is a plus 17%, the Dow Jones a plus 14%, and the NASDAQ at plus 12%. Again, those are year-to-date returns.
Yeah, and those are despite the little bit of a pullback we've been experiencing the last couple of weeks in the market, still overall posting strong numbers on the year.
Okay, well, thanks, Paul, for that update, and stay with us. We'll be right back with our next show called Your Money, and we'll be right back. Thank you. And we're back with Your Money. Paul, is an excellent topic. You know, it affects almost a whole large of people that own homes. Do you consider a home, should that be considered as part of your retirement asset? I want to rephrase that a little.
No, you phrased it perfectly, because for many people, their home is their biggest investment.
Yeah.
And then, yeah, do you consider that as part of your retirement? So I've got some answers for you. Let's dive in.
Let's go.
All right, so if you do own a home, again, chances are your net worth has shot up in the last year just because the prices of homes have gone up. So according to a new report, skyrocketing home prices caused by a pandemic-fueled real estate frenzy have led to a scenario where homeowners in the U.S. are sitting on a record $22.7 trillion worth of home equity. Now, seeing the estimated value of your home increase on real estate sites, it can be exciting, especially if you're counting on that money to one day help fund your lifestyle in retirement. But it's important to remember that real estate is a more complicated asset than cash. Keep these factors in mind as you consider how the value of your home may be used to bankroll your retirement. So number one, of course, you need somewhere to live. So whether it's in your current house or somewhere else, you need a roof over your head, and that usually comes with a sizable cost. Many people who downsize their homes underestimate how much they'll end up spending on a smaller condo or to live in a retirement community. In fact, some come to realize that their new accommodations are on par or even more expensive than their previous homes, especially considering that they may end up spending 2 or 3 decades there in retirement. Now, regardless of your situation, do the math, so you know what you're getting yourself into financially and how it will factor into your plans for retiring. Point number 2, selling your home might not be as easy as you think. So given the strong demand and short supply of houses on the market, you may be seeing homes sell at lightning speed in your local community. But it's important to remember there are no guarantees. In some areas of the country, hot housing markets are beginning to cool. As a result, you might be disappointed in the price you are able to generate when you sell your property. Many people have been disappointed to discover that their home is not as valuable as they might have expected. It's important to keep a pulse on the housing market in your area to help determine what you may be able to get for your home. Point number 3, determining a home's value can be difficult. So compared with a stock, bond, or mutual fund that can readily be priced in the market and bought or sold daily, a home is a different kind of investment. The value can't be precisely determined, and it is not considered to be as much of a liquid asset. If you're serious about selling your home, it may be worthwhile to hire a professional appraiser to give you a realistic sense of how much you can expect a buyer to pay you for that home. Now, keeping these factors in mind, it's important to maintain a proper perspective about the value of your home in the context of your overall financial picture. Be careful not to overestimate a home's contribution to your retirement security based on its current valuation, because those numbers can change. Even as your home is appreciating in value, remain diligent about saving for retirement in other ways, such as through a workplace savings plan or maybe an IRA. As always, talk with a financial advisor about your plans for retirement and your home's potential value in your overall portfolio. A qualified financial advisor can recommend strategies for generating income in retirement and provide guidance on how to build equity regardless of your home's value. Then, any funds you generate from your home will be an added retirement bonus. So lots of things to consider. Again, we all enjoy, for the most part, our home values going up throughout this pandemic, but how it fits in your portfolio is specific to you and your home and your situation.
Paul, the most important thing that you have said out of all those points is do the math. You can hire an appraiser to get a value on your real estate, but that does not mean that's what the market will bear. It could be higher or it could be lower.
Yep.
The value could change depending on where the market is at that moment. And right now, as you had already mentioned, it's bubbled a little.
Yes.
And it's coming down in certain areas. So it's so important that if you are going to take your assets and convert them into an income for your retirement, that you really do the math and you get professional help.
Well, keep in mind too, that value that you see for your home on Zillow or even appraiser may give you, you got to subtract from that realtor costs. You got to subtract from that moving costs. You got to subtract from that potentially taxes if it's not a, direct transfer exchange, property exchange. So there's deductions that need, and there's other deductions that need to be made from that real estate transaction. You got to factor all that stuff in to make sure it is going to be profitable or make sense. Like I talked about in today's show, sometimes that downsize doesn't necessarily save you any money in the long run.
Exactly. Good points. Excellent good points. Paul, thank you for bringing that topic. For Paul Munico with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.